society. And we're happy to share with you guys this afternoon our portfolio pitch that managed to win us first place in this 2025 Ignite Stock Pitch Competition. So, without further ado, I'll first start by stating our investment thesis. So, we believe that you guys should opportunistically invest in defensive sectors in the Philippines like real estate, utilities, and banking by taking positions in industry giants as well as medium companies, mid-cap companies for growth. So, before stating our portfolio allocation, we'd like to first answer the question, what is happening in the Philippine economy right now? So as you can see, there are three tailwinds that we analyzed. So first is the growing consumption, second is the rising commercial activity, and third are supportive government policies such as the Create More Act, the CMEPA law, and many, many more. Next slide, please. However, some headwinds introducing risks and volatility in both the economy and the market are trade challenges, which results in weaker external earnings and capital flight, geopolitical conflicts that raise import costs and deter foreign investor confidence, and lastly, the negative consumer sentiment that makes domestic demand less favorable and slows consumption.
Next slide. Yeah, and given our headwinds and tailwinds, our team, through our research and our effort, really looked hard into looking at the different industries. And with that, we were able to narrow it down to just these four industries right here, based on what's happening in the current economy, macro, and all the stuff we know. Next slide. And with that, we were able to just focus on these three industries right here. First being the real estate, banking, and utilities. And the reason why is because these three industries are the backbone of the Philippine economy, whereas these three industries are irreplaceable in what they're doing as they're providing essential services to all the Filipino. Okay, starting from real estate, the reason why we chose it is because of the rapid urbanization that's happening in and even beyond the Metro Manila. Next is the government's push and effort of working together with the private partners and public to further develop our infrastructure, especially in places such as Cebu, Pampanga, Iloilo, and much more. And next is the recovery of the housing market, which is driving up the demand, and even the opposites again. And next up is the banking. First is the BSP rate cuts that has currently happened, and we may even be expecting another one. Next is the SME credit demand on the rise, and again, the effort of our financial services such as Team Trade Asia, many other banks, and the DICT in providing great finance services and banking, digital banking growth in our country. And lastly here is the utility sector. The reason why we chose it is specifically because it's one of the most stable industries out there. No matter what is happening within our economy and even in the whole world, it still has good cash flows. And next is the rising energy demand, especially since I mentioned a while ago the different townships and CBDs that's being made in our whole country. And lastly, this one is together again with the government, DOE, and public and private again, is the development of making our energy mix become more sustainable and renewable. To the next slide.
The portfolio allocation of 40% of banking, 38% of real estate, and 22% for utilities takes advantage of macroeconomic tailwinds. We've already talked about the economy. We've chosen which sector with most profit in that economy. Now we're going to talk about how to allocate per stock per sector. And we did that through two ways, one quantitatively and qualitatively. Quantitatively, we use the mean variance optimization to maximize the Sharpe ratio, or at least the return per risk of each of our stocks. And it resulted in these allocations. To summarize, 40% goes in banking, around 40% in real estate, and 20% in utilities. As you can see though, sa allocations per stock in the outer ring, more weight has been given to the stock that has higher returns. For example, we have 30% on AUB and 18.41% in DMC. These are stocks that have higher yields and of lower risk. However, it's also a balancing act because we can't be too greedy and focus only on the returns. We also diversify our portfolio with holdings that have low correlations with our major holdings, such as Meralco and DPC. And this is in line with our macroeconomic analysis, which is that real estate and banking take the lion's share because they drive growth, and that utilities stabilize our entire portfolio. Next slide, please. However, even with that, when you invest, there are some risks to consider when investing in the market. The risks are systematic risks tied to the market. These are risks that you cannot mitigate and that affects all stocks. The risk of this includes interest rate hikes and inflation spikes. Then we have idiosyncratic risk that can either be sector-specific, like real estate downturns or commodity price swings, or company-specific, such as management or governance issues. However, we cannot just stop at that. We have to mitigate these risks. And with that, we have three ways. Firstly, through diversification, and not only for diversification's sake. We diversify our holdings across moderately correlated sectors and names, meaning that we don't put our holdings in stocks that all go up when the market goes up and goes down when the market goes down. We diversify our holdings to like utilities that are necessary so that even when the market turns sour and our banking and real estate may take a hit, we still have our stable utility earnings to salvage our risk. Second, our defensive selections. We chose firms with strong moats and resilient cash flows. Lastly is our risk-managed structure. Overall, when we do the calculations, our portfolio has a beta of 0.29, which means that we have effectively mitigated systemic risk. And this is because when the market turns down, we only go down a much lesser percent or degree. Second, we have a portfolio standard deviation of 12.67, which proves that we have diversified away idiosyncratic risk, because this is lower than both the PSEI and the individual standard deviations of our stocks combined. With that, all we're saying is that although there are risks in the market, we have mitigated this through our three mitigation strategies.
Next slide, please. Given our chosen industry, we anchored our portfolio to industry giants or big companies in those industries with a strong competitive advantage and steady growth. So what are these three companies? Firstly, we have Metrobank, the third largest universal bank in the Philippines, and it has a very good competitive advantage in its size, and it's very well established here in the Philippines. Nextly, we have Meralco, where they are a regulated monopoly selling essential services without competitors. Nextly, we have DMCI, wherein they have a diversified business segment that is vertically integrated, that helps them with synergize their operation. These three companies are one of the biggest in their industry, which makes them more safer, and they also have steady growth. These large companies will provide stability and hedge risk for us. Next slide, please. So, with that, we also complemented it with calculated investment on mid-cap or smaller companies with highly exceptional performance, particularly growth. So we believe that this company, they have very exceptional performance, especially in their growth rates, especially in the future. So we have here Mega World, Robinson Land Corporation, Asia United Bank, Price Power Corporation, with the past 5 years earning growth rate in the double digits, except for Robinson, but they have big upside potential due to their valuation. So these companies will unlock growth opportunity for us. Next slide, please. All our companies have led to above industry average financial performance across every metrics: in profitability, in return on investment, in dividends, in financial health, in their valuation, in their growth rate, and in their ESG factors as well. Next slide, please. And then, we also use relative valuation model to show that these very undervalued companies are really poised for capital appreciation. So these companies are RLC, MEG, and MDC. These companies have a big upside potential with a big margin of safety, meaning to say that from a value investing standpoint, the reward is high and the risk is very low. Next slide, please. To sum everything up, the catalysts pushing growth are growing consumption, rising commercial activity, government support, as well as interest rate cut and monetary policy. Second, there are some risks to monitor. These are market risk, market-wide risk, company-specific risk, trade challenges and tariffs, geopolitical conflict, negative consumer sentiments, which we can mitigate through this strategic portfolio allocation, diversification, peso cost averaging using our dividends, and then the whole philosophy of defensive industry selection. So that's why we also took position in industry leaders like Metrobank, Meralco, and DMCI, as we believe they are very safe investments, and we also take calculated bets on exceptional underdogs such as Asia United Bank, PPC, Mega World, and Robinson, which all of these have above average metrics in every financial performance metric, even ESG. So with that, next slide. Thank you so much. We now open the floor to your question.